Okay, welcome everyone to our news trading session, and this is going to be a theory and practice. And we are probably not going to spend too much time on the theory. I do really want to spend a lot more on the practice side of things. But yeah, if you guys have any requests on anything specific you guys want me to take a look at as an example, then we'll use that. But I think for now, basically in the past hour, we just got the release of the interest rate decision from the Bank of England. We're probably going to be focusing on the sterling as an example later on tonight's sessions. All right, cool. Thanks for joining in. All right, we'll start with a quick disclaimer first. Leverage trading involves risks, so make sure that you trade responsibly. Regional restrictions apply. Terms and conditions does apply as well. This is for educational purposes only. It's not a financial advice, and do keep in mind and always keep in mind that past performance is not indicative of future results. We definitely look at past performances. We got some positives, especially with last week's live trades and whatnot. But yeah, you can always refer that as something that will kind of be like 100% every single month. So just keep that in mind. We do look and refer to what has happened in the past, but they are not, kind of guarantee for future results. So just keep that in mind. So I need to kind of clarify a little bit on this disclaimer here. All right, I'm going to show you the codes for participating tonight. So that would be the promo code I'll show you now, and then I'll show you at the end of the session as well. And then you should already have access to the private Telegram channel if you have attended our live trading sessions before, or if you registered for this webinar on Octa's website, you should be receiving those email to the Telegram channel as well. All right. So this is the code. It's on Farm 2025. So feel free to use the code. It is a one-time use code, so make sure to use the code at the right time to kind of maximize your bonus. Okay, but yeah, I think there's actually a lot of codes provided as well. Kind of like if you use one up, I wouldn't really worry about it too much. I think there's going to be constant promotions from Octa and from other speakers as well, so you can use the codes. It is valid until the 31st of December 2025. So yeah, save it and use it when you need to. All right, just a little bit about myself. My name is Verenjero, and I am a global macro strategist. I'm also an institutional market analyst as well as an institutional trader. My specialty is in the Ishimoku Kinko Hyo, so I have over 20 years of professional trading experience. That would be across Forex, index, commodities, and futures. Again, I typically trade with institutional level, not on the retail level as well. All right. Used to be the former head technical analyst at GFT Markets. It's now Gain Capital. right? Also, X has strategies for invest financial services, which is in Australia and Japan. Again, my expertise is in Ichimoku Kinko Hill. So, we did a couple of videos on Ichimoku Kinko Hill. I think there's a lot of disinformation out there. So if you want to refer to the proper Ichimoku Kinko Hill, we did our Japanese charting techniques in this channel. So you can look it up on the playlist as well. All right, I'm also a regular market guest on BBC UK, Channel News Asia, CNBC, as well as Bloomberg. I've also been a trading coach since 2007. Trading coach as in I'm not really teaching traders how to trade. It's more really on helping professional traders how they cope with trading, right? It's more on that level, okay? Okay, so that's just a little bit of myself. We want to focus on news trading. I want to go through very quickly on the theories for tonight. And there are obviously a couple of advantages and disadvantages. So we'll talk more about the advantages first. It is high volatility. That would be good for traders, right? If you understand the definition of traders, you definitely want to be looking for that volatility. As an investor, you do want to avoid high volatility, right? So that's two different ways to look at the market here. Now, if we look at high volatility, then we're looking at high rewards in the market, right? So major news releases, this causes strong price movements. It does create multiple trading opportunities, like what is happening right now with the sterling. Now, I know the news has been released, and I think we're going through the press conference. I think press conference is also has been underway for about half an hour now, probably, or more. But yeah, this is kind of in a high volatility market right now. In certain currencies, like anything sterling related, that's going to be highly volatile. If we take a look at the Euro USD and the shift in the sterling, it's also affecting the Euro USD as well. I'll show you that in a minute. But yeah, that's one of the advantages there. So if you don't want to stay too long in the market, then you want to trade around news times, in times when news are getting released to get that high volatility. All right. On the flip side, it does create unpredictable spikes in the market as well. So if you get it wrong, that high volatility means there could actually be high losses as well. So you have to understand in terms of how we take advantage of volatility as a trader. If you're looking for something that's high reward, it's usually accompanied by high risk in the market as well. So it does come down to your risk profile. If you're not someone that's willing to take higher risks in the market, then don't trade news. Simple as that. Okay. So I'm just gonna give you guys one warning on here. For this series sessions, I typically don't cover this kind of warning on live trading sessions. But if you are not someone that is comfortable taking risks in the market, don't trade news. It's as simple as that, because during news releases, sometimes we don't know what the market is anticipating, or sometimes it might overshoot. We might actually get negative numbers that could actually impact the market in a different way. And I'll probably take the example for the release on the sterling just now. There was a rate cut, right? And the assumption with the rate cut is that the currency itself should weaken. But if you take a look at what happened, the sterling actually kind of went up, right? If you are not in the clear in terms of understanding the fundamental impact on this, then, you probably should be avoiding, releases like this, because the number was a rate cut. It was a 25 basis points rate cut. But the impact that we have here was for a stronger sterling, because the voting that we had was 5-4. So it was basically barely at about 50-50. There was only one vote divided between cutting interest rates and not cutting interest rates. Okay. And if we take a look at the consensus, I think the voting for tonight was that we're expecting 2 to not vote for a rate cut, and 7 to vote for a rate cut. We only got 5 voting for a rate cut. 4 was actually voting for unchanged rates. Okay, so that was actually very hawkish in the market, and we can see that impact on the sterling immediately. Okay, now when it comes to the spikes in the market there, it does cause slippage, it does cause spreads to widen as well. So just be mindful, that's kind of the risk that you have to factor in as well. You might not get in at the best price. Sometimes you get dragged around in the market, or orders might not get filled immediately as well, depending again on the liquidity and how big of an impact that news is going to be, okay? All right. The other advantage here is that it is time efficient. All right, trades are often short-lived. Like last week when we did our labor numbers, it's really up to you, but I don't really like staying too long when we trade the news there. If I can get out within the first 1 minute, I would do that. If there was a 5 minutes window and I'm able to get out in that 5 minutes window, I'll take that profit instead of letting it run and then, you know, leaving it to a lot of unknowns. It's very different to how we look at the market, typically with the target levels and whatnot. When we do trade the news, we read the volatility, we read how price change in terms of how quickly price change, and basing on that, you know, if the market kind of just cool down a little bit, we typically want to get out of the market before, you know, it kind of just flips the other way around. Okay. So very time efficient, setups forming, resolving quickly after the news. In fact, for our live trades, we typically set up our trades maybe about 5 to 3 minutes before the news is actually released. So very time efficient, right, in that context. But the negative to that is that you will require a lot of precision, right? Because entering even a few seconds too early or too late, this does result in poor fails or invalid signals. So just keep that in mind. Now, with the other advantage here is that you have clear timing, because we know exactly when the release happens. If we're looking at the scheduled releases, we can take a look at the economic calendars. You know, we can be ready for that release before the market reacts to it, right? But at the same time, there's always that whipsaw risk as well. You know, price may fake out in both directions before committing to a trend. Typically happens more on data like the NFE numbers on a normal scale. Last week was a normal. It was predictable, but it wasn't in a normal context. I think the revision from the previous month was just way too big. All right. The other positive is that we have directional conviction as well. And news often aligns to market consensus. This reduces indecision in trend direction. I would say yes, I think this is a positive if you kind of know how to actually read the fundamentals of things. But if you're not really clear on the fundamentals, I think it's good to, you know, come in for a couple of sessions, because we'll give you the context, we'll go through the fundamentals, or you can follow our weekly market outlook. That's when I publish the potential macro news that could actually impact the market as well. So yeah, it's always a good thing to kind of just load up Monday, you know, spend some time looking at the market outlook that we provide here. All right. The other negative to this is that if there's no reaction, you need to be able to hold yourself from trading, because if there's no reaction in the market, we don't pull the trigger on that. The last time, this is actually pretty recent, the last number that we didn't pull any trades at all, I believe, was the inflation number. We actually did pull one on gold, but it was more on waiting for things to happen rather than, you know, taking on the stop orders and whatnot. All right. So sometimes you get big news like that getting struck off by the market entirely, depending on what the market is looking at, depending on the context of the market, whether or not that data is actually very important, or, you know, there's other things that would take place or would replace the importance of that data. Okay. Now, the last advantage that we have here is that news trading, it works with both technical and fundamental strategies. Again, let me just remind you that the news trading that we're doing here, it's not fundamental analysis, okay? Fundamental analysis is a completely different thing. Fundamental or macro understanding of an economy is a completely different thing as well. It does take time to develop. So it's a good thing to not mix the two up. News trading is a completely different way to trade the market. It's not really 100% fundamental analysis. Okay, fundamental analysis is a completely different thing. It's really more on understanding how the economy works and whatnot, while news trading, it's really more on reading the reaction of the market towards a certain data releases. Okay, now can you combine technical and fundamental with news trading? Of course you can, right? Do you need technical and fundamental? You don't. You don't. If you want to follow the setups and whatnot, you technically don't need the technical analysis side of thing or fundamental analysis. But if you understand them, then it will actually improve your probability by a huge margin, right? It'll improve your win rate by on a higher scale because you understand what's going on in terms of the supply and demand, you know, where the potential resistance and supports are, and what is the context on the fundamental basis as well. Okay, now because of that, and because of all that we have here in terms of both advantages and disadvantages, it's really not beginner friendly. So let me just put that in disadvantage side, because I think I've seen a lot more traders, you know, getting harmed trading the news. So it's not beginner friendly because there's a lot going on here. It requires you to have that experience to handle the speed volatility with high discipline. Okay, if you don't understand risk management, this is not for you. If you don't understand your risk reward ratio, this is definitely not for you. So if you don't know how to manage your account, if you don't know how to manage your risk, this is not something for you. So let me just clarify this very clearly, because what I see here is that a lot of new traders, they come in with very low amount of equity and they thought they can multiply very quickly by trading the news once or twice, by, you know, just kind of just going all in, you know, fully leveraging all their equities and whatnot. That doesn't make sense. Okay, so just keep in mind, because of that high volatility, point number one is that, yeah, you can get high rewards, but at the same time, because of that unpredictable spikes and whatnot, it is also a higher risk trading strategy. Okay, this is okay because typically if you go with a high reward, high risk strategy, if your position size is okay in context to your equities, your trading equity, then it's fine. It's just that a lot of beginners come in, they thought, you know what, I'm just gonna go all in like that in that one single trade and hoping for the best. If you don't do that, I think you should do that somewhere else. If you really want to trade properly, this is not how you do it. Okay, so make sure you understand the difference, and this is why I say it's not beginner friendly, because beginners typically don't understand, or they don't really understand the discipline that's actually needed to pull this kind of trades. They also don't have that experience to understand what could happen with that trade. That's why we do the live trading session for the labor numbers and the inflation numbers every single month, so you can actually get a lot of practice. And yeah, all the videos out there, the past, I don't know, I think it's 2 years right now, it might be 2.5 years that we have been doing this news trading sessions here. So it's all recorded. You can actually look at the performance that we have there on record. So there are good days, there are bad months. It's all in there. Okay. All right, so those are the advantages and disadvantages. Let me just pause a little bit. I'm still having a little bit of a cold here, so kind of need to clear out my nose a little bit. Just give me 1 second. All right, and we're back. Okay, let's talk about type of market moving events. Yeah, we're on time. Don't worry about it. Okay, so we got hot or unexpected news. These are going to be unplanned events that often cause sharp market reactions. It could be terrorist attack. It could be military conflicts. It could be natural disasters. And I should add in there, we could have Trump in the market as well right now, right? That guy's just so random right now. And he does cause a lot of chaos in the market. Right about now, it has been about 6 months so far. Yeah, but at least 4 to 6 months. I think there's a lot of volatility in the market, and a lot of turnaround, a lot of whipsaws that happens in the market because of one guy. Okay, so those are going to be a hot unexpected news. Okay, so if we have a terrorist attack, if we got military conflicts, and in fact this year we have done a lot of military conflicts. We got obviously we got Israel and the Gaza Strip stuff. I think about a year and a half now. And then we got Iran with Israel, and then I think we're now back to Russia, Ukraine again, which has been ongoing for I think pretty much at least 2 years right now at this point in time. Yeah, these are going to be our unexpected news, right? We don't have a schedule for releases, and as I said, we got Trump right now. That I should start putting his name in our slides going forward. I would say, because I think he's just such a huge anomaly in the market at this point in time that we should include him as potential disasters for the market. Okay. So we have to keep that in mind. These are your unexpected news. We don't know when they are actually going to be released. I could be trading for 50 years for all I care. And I wouldn't be able to predict when that is going to happen unless, I'm doing some insider trades and whatnot, which is kind of illegal. But yeah, we just don't know what to expect for that one. We can kind of predict, what could actually happen. How we look at the labor numbers last week, and we mentioned this in the outlook. I think it was about 4 months ago or 3 months ago. I think it was about April, May, when Elon Musk and Trump was cutting out civil servants in the U.S. Obviously, that Doge thing that would actually impact how the BLS reports stuff. It's kind of predictable to a certain degree, but it's still unexpected that they kind of revised it that low last month, right? We know, or we can actually predict to a certain degree that it will happen in the future, but exactly when, we just don't know that, okay? All right, those are going to be a hard unexpected news, okay? Then we have the scheduled periodic news. This is what you use to news trade, okay? These are regularly published economic indicators as well as central bank communications. We got central bank meetings, interest rate decisions. We just had the Bank of England just now, exactly an hour, 25 minutes ago. So yeah, you have to keep that in mind when that is actually going to happen. Obviously, central bank meetings is going to impact the currency that you're looking at. If we take a look at the Bank of England, obviously it will impact the sterling a lot more than any other currencies. It probably wouldn't impact the Aussie much. The euro will be impacted because of their geopolitical location there, and considering that UK is part of ex-euro, sorry. So it will have that impact there because they're so close to one another. They're going to be directly impacted, okay? And then we have the inflation indicators there, which is going to be the one that we're going to be trading live next week on Tuesday. That's going to be our CPI numbers, as well as the core CPI. We got quarterly GDP reports numbers. We actually don't have any trading session for quarterly GDP, but this one here was just released last week. Okay. Employment data. This was the NFP sessions that we had last Friday. That's what we call the U.S. labor data. But it doesn't just apply to the U.S. labor market. If you're trading the Australian dollar, obviously you're going to be looking at the Australian unemployment rate. If you're trading New Zealand, you should be looking at New Zealand's unemployment rate this week as well. Okay. Then we have the ISM PMI numbers there. We just had services PMI, I believe, and then we had manufacturing PMI last Friday as well. But yeah, these releases, they often set directional bias in the Forex, equity, as well as commodity markets based on how they compare to forecasts. Um, and this is where it's not really beginners friendly if you don't have anyone telling you the potential scenarios, what could happen, how it would actually move the market. And this is why we do this session, so we can actually explain to you immediately once the data is released, why is the market reacting like that. And that's basically what we did. Okay, if you missed out Friday's session, I would highly recommend that you watch that session so you understand that how quickly we break things down, and kind of take the movement in the market there. Okay. All right. So most profitable news events to trade, obviously we have the CPI numbers, and why it's profitable, because it drives central bank rate decisions. This is actually going to be very important for the FOMC interest rate decision going forward, because we already have a shaky labor market last week. If we have a high inflation, and that would actually kind of go against the potential outcome for the FOMC's rate cut, right? If the inflation goes up, well, even though the labor market, it's not doing that well, the FOMC is not able to do anything. So the only thing that would actually support the rate cut to happen a lot more this year from the FOMC, I think we got two price in, one for September and I believe one for December. That's what the market has been pricing in. If you get a weaker inflation numbers, then yeah, that market will actually start pricing in more rate cuts. But if inflation goes up because of Trump's tariff, and logically so, it will put the FOMC in a very tough spot. Okay, all right. So we typically get a strong US dollar reactions, especially with the US data releases. It would actually impact gold as well as the Forex market. So it's not really isolated into one side. And we got the NFP numbers. It does trigger volatility across the dollar pairs. All right, we got Dow Jones, Nasdaq, maybe, right? If you're trading the futures, we got gold, and then we got the major FX market that has the US dollar spikes pretty much immediately. FOMC rate decisions, direct interest rate movement, dollar volatility, equities and bonds also whipsaws as well. Don't need to dive too deep into the bond market. There is actually a very strong need to understand the bond market for this year, especially with what's going on in the US. But don't worry about it too much. If something happens, typically we'll explain to you on the weekly market outlooks. Okay. GDP reports, they basically reflect the overall economic health. Luckily in the US, I think there was actually an improvement from negative 0.5 the previous quarter. So I think for now it's okay. And then this is where you get your currency valuation adjustments as well. PMI numbers, we got ISM services and manufacturing numbers, right? These are going to be a forward-looking view of growth conditions. Typically, if you are not into fundamental analysis, you don't really trade this number unless it's really a huge off, or if it transitions barely, transitions from below 50 to above 50, or above 50 to below 50. All right, it's a completely different thing there. But I think we did previous sessions on fundamental analysis as well. So if you want to look it up, I did explain what the PMIs are for and how to read them. Okay. Right. So let's go very quickly here, and we basically want to look at three main phases of price movement before I give you the examples tonight. It's not really a sideways uptrend, downtrend kind of thing. We need to understand this example here is an uptrend, but yeah, we basically need the market to stay calm before the news is actually released. And then we got participation, which is phase two, when the news is actually released. The difference here is that accumulation happens when you have information or knowledge that maybe other traders don't have that. And I would say this is where I would just tell you right now, if you're a retail trader, you're unlikely to be in that accumulation phase, right? You're not going to be the most informed. You're not going to be the most forward-thinking insiders that is able to enter the market or start accumulating positions, right? The market goes sideways before the news is released because, typically institutions or people with larger funds, we would classify them as professional traders. I don't know how that's classified in your country, but in Australia, I believe once you start trading above 250,000, then you're not considered retail as a trader. So I think there's a cutoff there. Okay, but anyone that trades below 250,000 is going to be considered as a retail trader. That's the cutoff there. Okay, so number one, when we say accumulation, that's not going to be you. I would assume you guys are going to be retail traders if you're watching this webinar here. Okay, the fastest you could get in would be at the participation phase, and this participation phase are not going to be for new traders. People that understand fundamentals, people that understand technical well, they are going to be in that participation phase. They are able to enter the market at that point when the news is released, at the point when the markets start moving in one direction. That's where they get in. Okay. Now distribution, this is where everyone else enters the market, maybe not knowing what's going on. For example, I'll just show you the chart right now, and we'll take a look at the example here on the sterling, right? If you saw the market goes up like that, and I can show you very clearly in terms of what the accumulation that happens here on the sterling here, right? If we take a look at the accumulation, it actually start accumulating this morning. It was actually last night. But if you want to classify that as an accumulation, this is actually the accumulation part this morning. That's one accumulation. The second accumulation actually happens, not this morning. Yeah, it is this morning. This is on the 15-minute time frame. That's the second accumulation. So we got one accumulation, second accumulation, and then the breakout happens here. Now, where's the participation for this one? If we classify these two levels as accumulation, the participation phase happens pretty much just about this area here, right? And right now, if you're entering here, you are actually in that distribution phase. Okay, so people that buy in here are getting out from their positions, right? That's why you see that short dip there. And basically anyone that jumps in here are your distribution phase, right? They're late to that information. The market has already started moving a lot. Simple as that. Okay. So this is why you need to understand the phases here. I'm not talking about an uptrend. I'm not talking about downtrends in the market. I'm talking about when the market shifts in a certain direction. There is actually a pretty distinct patterns there as well. Okay, so black is good, blue is fine, right? Don't be part 3, don't be in that distribution, because that's where people with late information or people thought, oh, the market has started moving, I was waiting for the market to move before pulling the trigger. I get in, and typically you get an example here, you get in at the very top, and then once you enter, the market actually reverses, kind of take you down into negative territory, freaks you out, you close your position, and the market goes back up again, right? I think you guys experience this a lot. As I said, it's not going to be beginners friendly, because the timing in the market is actually very crucial. Getting in late, maybe even 1-2 minutes late, it will change the complete scenario here on what you're dealing with. So just keep that in mind. I can give you an example here in terms of how quickly the market shifts. This is on the 50 minutes time frame. If I switch on to the 1 minute time frame, you can see that shift here. This is only 1 minute, right? So even if you're 1 minute late, you're gonna get a price that's actually way higher than where it could actually be. You might actually getting at 1.3420. Market might pull down 20 pips, might freak you out, negative 20 pips. You know, if you adjust your position size correctly, that's completely fine. On a mini lot, I think it's just 20 bucks. But if you jump in with a high lot on a standard lot, it would actually mean 20 pips is about 200 US dollars, right? Minimum. I think we were talking about. No, 20 pips, 100. Yeah. Is it? Yeah, it is. It is about 200 US dollars. Okay. What if you only have $300 in your account? It'll freak you out. It'll take down 70% of your accounts. So timing is crucial, and I don't recommend going on a 1 minute time frame because it's just gonna freak you out even more, especially if you're a beginner. You know, higher time frame has less noise. You know, you're not able to identify this accumulation phases if you're looking at it on a 1 minute time frame, because that would actually be a very long accumulation phase. It'll actually cause a lot of panic for you. You know, for even 5 minutes, I would actually avoid 5 minutes. If you're very new, if you're used to it, then that's completely fine. You know, it depends on how you trade the market. All right. So a couple of general rules for news trading. So before the news, you have to study the market in terms of the context, understand the dynamics of the currency pair that you plan to trade. You need to review past reactions to similar news releases to identify behavioral patterns. And this is why I say, you know, we have done this the past 2.5 years. So that's a lot of example for you. At least we're talking about 2.5 years. It's about 30 months, right? So you got 30 months. We do live trades twice a month. That's actually 60 examples for you to actually look at. That's actually a lot, right? So yeah, feel free, check out the channel. You got 60 live trades that you can check out there in terms of news trading. So there's actually 60 news releases that you have been watching if you have been following me for years here. So you need to review those past reactions, right? Before the news, you also need to mark key support and resistance levels on your chart to anticipate breakout or reversal zones. You also need to define a strategy. Again, are you going to be trading the news spike? Are you going to be fading the reaction? Are you going to be staying for, how long? Are you going to be staying for a minute, 5 minutes? And last week we said, if I can get out in the first 5 minutes, I would just get out. And that's basically what I do. Even though if I had stayed longer, I would be a lot more profitable. But I think some of you actually stayed on longer and managed to move your positions to a risk-free trade there, hopefully. All right. All right, then you also need your execution plan. So you need to set a trading time frame. If you're scalping, 1 to 5 minutes intraday, 15, 30 minutes. If you're doing swing, you need to be looking at an hour, 4-hour daily time frame. Because we're news trading, we don't go beyond the hourly time frame. I typically look at the 50 minutes and the hourly time frame to look at the accumulation phase. Okay. You wouldn't go into the 1 minute and 5 minutes because I think there's a lot more noise that could actually change your perspective a lot. You also need to control your risk. As I said, very important. You need to determine the maximum acceptable loss per trade and then apply proper position sizing. As I said, if you don't understand risk management, then you're not going to be able to really optimize news trading. It would actually put you at a greater risk. Okay. Always use stop loss, always use trading stop if you are into that. I don't use trading stop, but I think a lot of traders like to use trading stops. I just don't like trading stops. I like to measure my risk and adjust those stops, accordingly. All right. But if you're inexperienced, you don't know how to adjust your stops, then, trading stop is not a bad thing. Okay. Again, as I always say, this is actually what's really important. Decide whether the trade will be short term, right? 1 to 50 minutes. I'll say, 1 to 5 minutes for me. Or you want to hold it post news longer than an hour. It's completely up to you. Everyone is going to be different. Okay. Daniel just said he didn't realize it has been that long. It has been that long, right? Can you, I kept saying this every single month. And it has been that long. It's been that long since we've been doing news trading sessions. So yeah, 60 live trades just on the CPI NFP. So if you have been following for 2 years, you can go tell your friends, I've gone through 30 NFPs, I've gone through 30 inflation numbers. So yeah, I would know how it actually works. It should be enough, right? 30 is a lot. People don't last that long typically. I see a lot of people actually come into trading. The best I can do, maybe 3 a year. If you improve yourself very quickly, then that's where you can actually stay trading for good. But I think a lot of people just try it out, maybe 3 months, 6 months, they're gone, and they don't have that knowledge, they don't have that example, they haven't gone through 10 months of news releases. So it's actually very hard, but we have this, it's all recorded, it's all there in the channel. This is why I say, it's always good to review past sessions as well. Okay. All right. So we got time, don't worry about it. I want to go through very quickly what we're going to be doing for tonight. We'll be using the buy stop and the sell stop, and we're also going to be showing you the sell limit and the buy limit. So this is a very easy example to clarify what a buy stop is. The use case for a buy stop is that when you expect price to break above resistance and continue rising, that's when you want to use a buy stop. So your strategic intent here is that you want to enter on a momentum breakout or a trend continuation, you use a buy stop, okay? If price breaks above 1.1 and you expect price to go up to 1.11, for example, you'll get in at 1.10005, okay? Sell stop is the opposite. If you expect price to break below support and then continue to go down trend, then yeah, that's when we use that, sell stop. So think about it. Buy stop is for the uptrend to continue. Sell stop is if you can expect the downtrend to continue. That's when you use the sell stop. So it's the opposite of that. Now, the sell limit and the buy limit is the opposite of what we just talked about, the stop levels. The sell limit, the use case here is that if you expect price to retrace upwards into resistance and then fail, so you're not expecting a breakout, but you're expecting the market to fail at resistance, then you use a sell limit for that rejection, okay? You want to catch a pullback before that downward move, you want to use the sell limit. The buy limit is the opposite. If price pulls back to support and then bounce upward, then you want to use the buy limit here, okay? So the way we look at stops and limits is this. If we say stops, it means breakout or continuation to happen. Limits is going to be a reversal or bounce, okay? So this is to simplify stuff here. So let me give you an example here on the buy stop. If we have that corridor of volatility, we can place the buy stop and the sell stop here, and we'll just lock the range here. We don't know what the news is going to be. If it does create a move to the upside, a very strong move to the upside, then we will be in position because we have an order just above that range there. It will trigger the buy stop and then it will run up quickly like this. Now, if you're saying, oh, does this happen often? That's why I say, we're going to be using the sterling here as an example because I can go into a bar replay and I'll show you what happens here. And if we take a look at the range that happens, I know we already saw that breakout, but if we take a look at this, what we're trying to do here is that if we zoom in on the range that we have now, all right, this box here, this is basically going to be important, right? This is the box where we want to place our buy stop and the sell stop. So the buy stop will be here, and the sell stop would be there. What this means here is that I'm going to have a buy trade that goes like that. At the same time, I'm going to be creating a sell order that looks like this. Okay, so I don't know what is going to happen, but this is what could happen, right? So yeah, you know, if you take a look at this one here, this is before the news is actually going to be released. You can position yourself there. Obviously, we already had the breakout to the upside here, so the bias is really to the upside. I think there's already anticipation that the Bank of England could actually be a little bit more on the hawkish side there. I think market is already shifting a little bit before the release, but if they show up to be hawkish, then obviously it will benefit the sterling in a huge way, because no one was actually pricing in for that vote to be uh, 5 to 4, right? So basically about 60% to 4. So yeah, we'll see what happens here. You can see we're just waiting for this one to break out. What happens here is that when something breaks, we want to cancel the other side. Okay, so we only want to go with one side. And you can see what happens here. It just shoots up. In fact, it'll just hit your take profit level as well. So you need to cancel that order because this is really running to the upside. So you only have one position. So now, if you go back to the slides here, right, this is basically what happens here. It got triggered. And what we want to do here is that once you see the market goes up very strongly in one direction, you want to start moving your stop loss to break even, to kind of turn it into a risk-free trade. But you know, if we take a look at the reaction time on this one here, everything happens in 1 minute anyway. So you don't even have time to open the trade manually. You don't even have time to kind of close the trade manually as well. It opens and closes pretty much in an instant. You only have maybe 1 second or two. This would have been a really good trade. But yeah, that's why we use the stop orders, because we just don't have that reaction time. And we want to catch that movement like this, because again, as I said, we want to be at least in the participation phase. If you start buying in here, then it would be trading post news. You know, we really don't want to buy up top there, because if you buy up here, then your risk reward ratio doesn't make sense, right? And I'll show you an example on how we actually figure out what to do here, how we could actually trade what happens there. Okay, so let's go back to the slide there. You know, I just give you an example on the buy side and the sell side. On the chart, which is this one here, can we look at that range there, or can we use an example on what's happening here? Well, we can. I mean, if you take a look at the euro, is there an accumulation phase? There isn't an accumulation phase. There's no news actually being released right now. I think there might be some news tonight. You got initial jobless claims, but that's pretty much it. Probably not going to be a huge thing for the market there. But yeah, if there's actually a news being released, for example, in the next 50 minutes or so, what we're looking at it's always that zone where market can just flatten out a little bit. That's what we're looking at. So like this one here, once it breaks like that, then we want to take that trade. This one here is ranging, but again, this is on the hourly time frame. Obviously, this would impact more on the swing side of things. But yeah, I mean, if you look at this and say, okay, I might be looking at a little bit of a range developing here, but it is a huge range, right? I probably wouldn't want to be, you know, using a buy stop and sell stop for this one here, because it's 200 pips. But just for an example, if you're looking at patterns like that, then you can go, yeah, you can just right click. You want to use a buy stop, you want to go right click here, and you want to use a sell stop. That's basically what we do every single month for a strategy, okay? So going back to the slide, and again, I want to just explain very quickly in terms of how to use the limit strategy. Now remember, the limit strategy is like when we're anticipating a potential bounce or rejections that happen in the market. This example here is looking at the previous high there. We're potentially looking at that as a level where price could actually hit and then fail and then come down very quickly. And that's basically the example that we have here. Now, do we have this example in the market right now? Yes, we do. Because if you take a look at the sterling here, obviously the shift here on a fundamental scale, that is actually very positive, right? But we don't know what the bounce is. And if we take a look at the movement here, where the potential bounces are, but if we take a look at this example here, this is obviously on the 1 minute time frame, so it's not actually really fair. But if we go into the 50-minute time frame, and if we, it's going to be very hard for me to scroll back into that. So let me check on the daily time frame. What that level is the potential support. That would be, you should be able to find that maybe around the 28th of July, or at least on the 21st of July. So going back that far on the 50-minute time frame is actually going to be really hard. But if we go into the hourly time frame, we might be able to look at several stuff. Now, if we take a look at this expanded zone here, which is our congestion area, which is also going to be our order block, which is where price actually finds a little bit of support on 28th. That's where price bounces off on 21st. That's where we want to minimize the area where we might actually be looking at, okay, there might actually be a pullback. I don't know if this has actually happened. But if we look at that scenario there, that means I'm anticipating price to pull back to about 1.34, right? If price pulls back to 1.34, which is the lower end here, which is where price bounces off on the 21st of July, which I have to go into the daily time frame to identify, which means I'm using my technical knowledge to find what price has done in the past. I can use a limit order, okay? But if you have no clue on what I just said in the past 5 minutes, don't attempt to use the limit orders. And this is probably the best example that I can give you, that you're not forced to use that limit orders. If you know how to use it well, then you can use it. How do we use the limit orders here? Because I identified that the potential bounces happens on the 21st and the 28th. Therefore, for tonight, because we just had that break to the upside, intraday wise, if I miss that trade that happens there in the first hour, right? This is still happening in the first hour. I would go back onto what has happened in the market. In fact, price has already bounces off 1.34. I'm not sure if you're able to catch that very quickly, but if I'm looking at that right now, I would say, okay, price just bounced off 1.34. Some traders will actually put on a limit order there, but if not, price will come back to 1.34 again one more time before potentially bouncing back up. So I don't know if that has happened. I wasn't trading this just now, all right? But if that happens, then yeah, I would probably put a limit order there. If price goes down back to 1.34, then I would take the trade up there. Probably wouldn't risk too much. Probably put it at R1. I'll take R3 as our potential target there, and yeah, we'll see what happens. So it's still on the way. It hasn't picked it up. So if you miss a trade just now, then you would attempt to use a buy limit at 1.34. But I think that has already been filled. Data release is at 6 on my time. So about half an hour after that, price actually pulled back to 1.34 and bounces back up. So I think some people that actually use a buy limit, understand the market, would actually put that order maybe 1 minute or two after the news is actually released, and then pick it up at 1.34, target 1.3425, be done for the day. So if you don't understand the limit order, don't use it. If you understand limit orders, feel free to use it. Simple as that. So going back to the sterling here, right? If we plan everything here, if we take a look at the sterling here, was there any other levels we should be looking at? I would look at about, I would say about 1.34, because this is actually the area where we're anticipating for potential bounces here. So that would actually put it there at 1.34. So I would actually do a buy limit. All right, I can adjust it just about 1.34. So I'm expecting price to go down and then go back up. Okay, so I'm expecting this to happen, and potentially bounces off support, continue to go higher. And if we take a look at the formation that we have here, obviously the zoom that we have here, we can see that swing that happens in the market very, very clearly as well. I think that shifted pretty much on Friday, so it's pretty clear in terms of the turnaround in the market. And if you're looking for retracement levels, obviously we're currently looking at about approaching 61.8, currently being resisted there. It might bounce up, push 78.6, but that's pretty much it. Okay. All right. So, as I said, if whatever I just tell you in the past 10 minutes, if you have no clue, it just whiffed through you, don't use limit orders. Simple as that. Limit orders are not for beginners. They are really for traders that understand the technicals a little bit better. If you have that experience, if you have watched the SMC webinars, then yeah, I think you're okay to use the limit orders. But if you're not able to read price movements, I would say forget about limit orders, because that's really not up to your level yet. Okay, so don't force yourself into this. This theory session obviously tells you that there's actually 4 pending orders that you can actually use in the market, but you are not forced to use a limit orders. But try to get familiarized with the stop orders first. I think it's actually a lot easier as well. Breakout strategies are actually a lot more beginner friendly than looking at potential bounces on resistance and support. They are not beginner friendly. Okay, all right. So can you trade after the news is released? You can. Typically we use the limit orders, like just in the example that I just gave you tonight. So yeah, you can trade after the news is released, waiting for information. We processed that information just now, that comments coming out from the Bank of England was a little bit more on the hawkish side. Voting members, less votes on a cut. It's really balanced on whether or not they should cut or keep it unchanged, right? No one votes for any hikes, so it's not super hawkish or anything. Okay, I don't think we have time to go through this, but this example here, if you want to take a look at them, you want to screenshot them, use them as an example. But I'll give you the example here. If you see a suppressed rate hike from the Fed, which is not likely to spike, anything that has to do with the US dollar is going to spike. It will actually benefit the US dollar a lot more if there's a surprise rate hike from the Fed right now. If the NFP report is due in 10 minutes, what kind of pending orders would you place and where? If there is a range, if there's an accumulation phase, I'll use to buy some of the sell stop orders. Simple as that. If price breaks below a major support level right after CPI release, would you use a sell stop or a sell limit, and why? If price breaks below a major support level right after CPI release, I wouldn't use a sell stop. That means I would actually trade after the news. I would actually use the sell limit. So that would be giving you that scenarios now. Okay. So all 4 types of pending orders I mentioned to the scenarios there. If you're looking for breakouts in the market, then you use the buy stop. If you expect the uptrend to continue, sell stop. If you expect downtrend to continue. If you expect price to pull back, retrace a resistance, and test a resistance and fail, then you want to use the sell limit. If you want to buy on support, at support, then you want to use the buy limit. Okay? All right. Might actually have about a minute. So no, actually we are out of time on this one here. So if you're expecting a down movement from Nasdaq, we use the sell limit when the price goes up near resistance level. Yeah, I would say so. If you're expecting a resistance to fail, for example, at a new all-time high, at a psychological price level, at certain Fibonacci extensions, then yeah, you want to use the sell limit. Because using a sell limit, while it's not beginner friendly, it's actually much better for your risk reward ratio. Your risk reward ratio is at least going to be 1 to 2. It should be more than 1 to 2. Okay. All right. So this is the code. It's OnFarm 2025. Feel free to use the code. If you deposit into your Octa trading account, it's still valid until the 31st of December 2025. You have about 4 months to use it. So yeah, feel free to use the code OnFarm 2025. Otherwise, we will see you on Tuesday, right? On the 12th, which is next Tuesday. Same time, same place. We're going to be looking at the CPI numbers. We will trade the inflation numbers. And if you're new, that's completely fine, because we will go through some theories as well. And I'll give you the context of what we're anticipating for the inflation numbers. A couple of scenarios that we might actually anticipate as well. So yeah, tune in before the release. The release will come in at about exactly 30 minutes when we start the sessions there, okay? All right, thanks for tuning in. Good luck to your trades for this week. Again, I'll see you on our live trading sessions on Tuesday next week, which is going to be on the 12th of August 2025. Same time, same place. Stay safe.